U.S. natural gas futures dropped below $4.30 support after reaching a 25-month high of $4.50 in the prior session, pressured by EIA data revealing a smaller-than-expected storage draw. For the week ending February 28, U.S. utilities pulled 80 billion cubic feet of gas, falling short of market expectations of a 96 billion withdrawal. Gas prices surged earlier this week amid concerns that Canada might scale back its electricity and natural gas exports to the U.S. This came in response to U.S. President Donald Trump's decision to impose tariffs on Canada and Mexico on March 4, raising fears of potential retaliatory measures that could disrupt cross-border energy trade. And you know what? Canadian gas exports to the U.S. have actually declined to an average of 8.2 billion cubic feet per day in the days following Trump's tariffs. For comparison, Canada exported an average of 8.6 billion cubic feet per day to the U.S. in 2024, up from a 5-year average of 7.6 BCF per day. Overall, I believe this price surge is driven more by speculation than by fundamental data. In reality, Canada accounted for only about 1% of total U.S. power demand in 2024, including exports, some of which even flowed back into Canada. From this perspective, the potential loss of such a small portion of energy supply hardly justifies the current 30% price increase compared to seasonal averages. This suggests the natural gas balloon is overinflated and on the verge of bursting, which could spell trouble for the bulls. Some analysts claim that soaring prices in Europe are driving U.S. LNG exports through the roof. Well, let's take a closer look at the European gas market. Surprisingly, TTF prices have just fallen below 40 euros, the lowest level in over 4 months. Some interpret this as a signal that a partial resumption of Russian pipeline gas could be on the table under a potential peace deal. For now, if we align U.S. gas prices with the European market, the fair value for U.S. gas would be around $2.80. And please, don't even ask what will happen to the U.S. gas market if a peace deal actually materializes. Some analysts insist that the supply-demand balance is tight, but once again, that doesn't seem to hold up. So far in March, average U.S. gas production has climbed to 106.2 billion cubic feet per day, surpassing February's record of 105 billion. Meanwhile, forecasts indicate that total gas demand, including exports, will drop from 119 billion cubic feet per day this week to 111 billion next week. So, please tell me, if rising supply and falling demand aren't key bearish factors, then what is? Okay, sure, maybe another Arctic blast is about to send U.S. gas demand soaring. Well, according to meteorologists, the weather is expected to shift from super warmer than normal between March 6 to 15 to slightly colder from March 16 to 21. Wow! There it is! We've finally uncovered the real major price driver. From a technical perspective, natural gas is drastic all over bought now. The rally appears driven by speculation rather than solid fundamental backing, meaning a price correction could be on the horizon. A successful test of the $4.20 support will drive natural gas toward the next support level at $4. A failure to break support at $4 may trigger a short-term rebound, otherwise a deeper pullback will potentially drive prices toward $3.75 or even test levels below the 50-day moving average support. In the coming sessions, traders should keep a close eye on tariff negotiations and storage data, as both factors could heavily influence price direction. Please feel free to share your thoughts in the comments, whether you think I'm off the mark or maybe spot on. Please like, subscribe, and comment to support the channel. See you in the next one.